Welcome, everyone. Specifically, welcome to you, the learner. We are so glad you're here for today's deep dive. We're getting into something that is, frankly, going to melt your brain a little bit.
Right.
We're looking at excerpts from the Money Mindset podcast, specifically an episode called The Alchemy of Debt.
Yeah, and it's a really fascinating piece of source material. It completely upends everything you think you know about finance.
Exactly. And our mission for this deep dive is to basically shatter the illusion of what you think happens to your money. Like, we want to reveal the actual hidden mechanics of how the global economy runs. So let me just ask you this directly. What if the money you see in your bank account right now on your phone screen, what if it doesn't physically exist?
Right. It's a jarring thought.
It really is, because, we all have this analogy in our heads. We tend to view a bank as this highly secure, giant storage locker. You know, you get paid, you take your cash in, they put it in a little steel box with your name on it, lock it up, and just wait for you to come back and get it.
Like a literal piggy bank.
Yeah. Exactly like a piggy bank. But breaking that storage locker myth is like the very first step to actual financial empowerment, which is why I'm so glad we have our expert here. So break it down for us. If it's not a storage locker, what is it?
Well, I think the storage locker analogy makes sense because it feels safe, right? But the reality is that banks are not middlemen. They aren't just holding on to your money for safekeeping.
Wait, really? They aren't middlemen at all?
No, not functionally. They're actually money creators. That is their primary role in the economy.
Okay, wait. If they aren't just storing my deposit, then what exactly happens? Like, walk me through the exact mechanical process. I walk in, I deposit $1,000. What happens to it?
So the moment you deposit that money, it enters a system called fractional reserve banking. And this is completely legal, by the way. It's used worldwide.
Okay. Fractional reserve.
Right. So the bank takes your $1,000, but they only keep a tiny fraction of it in reserve. Let's say 10%. So they lock away $100 in the vault.
Okay, so they keep 100. What about the other 900?
They immediately turn around and loan it out to someone else, like maybe someone who needs to, buy a used car or something.
So they just give my money to a guy buying a Honda.
Essentially, yes. But here is where the math gets really interesting. That guy buys the car, right? And the car dealership takes that $900 and they deposit it into their own bank.
Right.
Now, that second bank follows the exact same rule. They keep 10%, which is $90, and they loan out the remaining $810.
Oh, wow. Okay, so someone else gets an $810 loan, and they spend it.
Exactly. Let's say they buy a laptop. The electronics store deposits the $810. That third bank keeps $81 and loans out $729.
And it just keeps going. Like $729 becomes $656, and on.
It just repeats in a continuous loop. The amounts get smaller each time, obviously, but if you track the total amount of money circulating, it explodes. Through this loop, your initial $1,000 deposit can literally generate up to $10,000 or even more in the banking system.
Okay, let's unpack this, because frankly, that sounds like a magic trick. Or honestly, kind of a scam.
It feels like it, yeah.
It's like a baker. Imagine a baker selling the exact same pie to 10 different people and just crossing his fingers, hoping they don't all show up to eat their slice on the exact same day. How is that legal?
What's fascinating here is that your pie analogy is actually spot on. The entire system operates purely on trust and statistical probability.
Probability. Like, they just do the math on how many people want pie today.
Basically, yes. Banks know, mathematically, that not everyone will ask for their money at once. Most people just leave it as digital numbers on a screen. As long as the trust holds, the system works. But if everyone does show up on the same day,
then the bank doesn't have the pie.
Right? That's what we call a bank run. And that's when the system breaks.
Man, that is wild. But okay, so we know how the money multiplies, but I want to look at the physical reality of this. Or I guess the lack of reality.
Yeah, let's get into that.
Because when the bank approves that $900 loan, they aren't like literally handing over the paper bills I gave them. Right?
Oh, not at all. And this is the real secret. When banks make a loan, they do not take physical cash from someone else's account. They just go into their computer system and type new numbers into the borrower's account.
They just type it in.
Literally just keystrokes. There is no physical cash transfer. Over 90% of the money in the world today is completely digital. It only exists inside computer servers.
That is just, it blows my mind. And the motive for them doing this is, well, it's just profit.
Real profit. Think about it. A bank creates a, let's say, $100,000 mortgage for you out of thin air. You buy a house. Over the next 30 years, you pay back $120,000.
Because of the interest.
Exactly. So they typed $100,000 into existence, but they get $20,000 back in real, actual profit.
Here's where it gets really interesting, though. Because if it's just keystrokes, I mean, it's literally like a kid playing a video game and typing in a cheat code for unlimited coins.
That's a good way to picture it.
But if banks can just hit a few keys to create wealth for their own profit, why doesn't this instantly break the entire financial video game? Like, why doesn't money just become completely worthless overnight?
Well, it would break the game if it was left completely unchecked.
Yeah.
They could just type infinite money with no rules. You'd have hyperinflation immediately.
Right, a wheelbarrow of cash to buy a loaf of bread type of situation.
Exactly. But it doesn't happen because this digital money creation is inextricably tied to something very real.
Which is what?
Debt. The newly typed money is a loan. When they type those numbers, you are legally signing a contract, pledging your future labor to pay it back.
Oh. So my future work is what gives the digital numbers actual weight.
You are the anchor. Your future sweat, your commute, your daily labor. That is what backs those keystrokes.
So because banks are creating this digital money as loans, that means every single new dollar that gets created is actually a new dollar of debt.
You've hit the nail on the head. Every new dollar is born as debt.
Which brings us to this massive macroeconomic tightrope that the whole world is walking on.
Yeah, the macro view is where it gets a bit intimidating.
Because if more loans equal more money, but also equal more debt, then the economy must always keep growing, right?
It has to, because the only way new money enters the system is when new loans are made.
It's like, I don't know, like a shark that has to keep swimming or it dies.
That's a great analogy. If people get scared and they stop borrowing money, or if banks get scared and stop lending,
Then the new money stops flowing.
not just stops flowing, the money supply actually shrinks. Because people are still paying off their old debts, which basically deletes those digital numbers from existence. So if new loans aren't replacing them, the money supply contracts.
And what happens when it contracts?
Economies slow down, they crash, you get severe recessions, businesses can't get credit, people get laid off, and people stop buying things.
So it's this incredibly delicate balance. Too much money created, like if the banks lend too aggressively, you get massive inflation. More money chasing the exact same amount of stuff, so prices shoot up.
Right. And too little money created leads to a recession.
And I want to clarify a huge myth here, because I think a lot of people listening probably assume the government is the one controlling all of this. Like, we picture the government printing presses just going brrr, making all the money.
Right, the classic image of printing physical bills.
But physical cash is what, a tiny fraction, like less than 10%?
Exactly. The private banks are the ones actually creating the vast majority of the money supply through these loans. The central banks, which are the government entities, they just control the system.
So the central banks are kind of holding the leash.
Yes. They manage interest rates. If they want to slow down money creation, they raise interest rates to make borrowing more expensive. If they want to speed it up, they lower rates. They regulate the overall flow, but the private banks are the engine.
Okay, but listen. If new money only exists because of new debt, isn't the whole global economy just a giant house of cards waiting for a stiff breeze? I mean, it sounds terrifying.
If we connect this to the bigger picture, I know it sounds precarious, it really does, but this debt engine is exactly what allows the modern world to function.
How so?
Well, think about a small business. Without this system, a baker would have to save up cash for 20 years to buy an oven. With this system, they get a loan, the bank creates the money, the baker buys the oven today and starts producing value for society tomorrow.
Oh, I see. So it accelerates everything.
Exactly. It allows people to buy houses in their 30s instead of renting their whole lives. It allows for car manufacturing, infrastructure. It's not inherently evil. It's an incredible tool.
But it needs supervision.
Right. It requires masterful regulation by those central banks to prevent the house of cards, as you called it, from falling down.
Okay, that makes sense. So we've looked at the global macro level, we see how the sausage is made, but we need to bring this down to the micro level for the listener. Like, how does this exact system affect your daily life, and what can you actually do about it?
Because it does affect everything. It affects your salary, your savings account, inflation at the grocery store, everything.
Because the money supply is constantly expanding, right?
Right.
Keep the sharks swimming.
Yes. And because it's expanding, inflation is baked into the system. things will inevitably become more expensive over time.
The source material gives a really good example of this. You buy a house on a 30-year mortgage. You take decades to pay it off. And because of interest and inflation, you end up paying back so much more than you originally borrowed.
Right. Your purchasing power is constantly being diluted by the new money entering the system, which is why the source material gives us 3 really actionable steps to handle this.
Let's hit those. Step 1.
Step 1. Do not rely only on saving money.
So, what does this all mean? Because growing up, we are always taught, a penny saved is a penny earned. Put your money in a savings account. Be responsible. Are you saying that in this fractional reserve system, traditional saving is actually a trap?
This raises an important question because it goes against everything we're taught. But mathematically, yes. If you just hoard static cash in a checking account, you are playing a losing game.
Because the inflation eats it.
Exactly. The banks are constantly creating new money, which means the money you have saved is constantly losing its value. You can't just sit in cash.
Okay, so you have to play the game. Which brings us to step 2 from the source.
Always fully understand debt before taking on a loan. You have to know the difference between an asset and a liability.
I always think of debt like fire. It's just a tool. It can burn your house down if you buy a bunch of liabilities, like putting a luxury vacation on a credit card, or it can cook your food and keep you warm if you use it to build assets.
That's the ultimate separator. People who understand the system use loans to build and acquire assets. Things that actually absorb that new money being created, like real estate or a business.
While people who don't understand the system use loans to buy liabilities, cars that lose value, big TVs, things that drain their wealth.
Right. And that leads right into step 3. Learn how to invest wisely. Because if you know the money supply is expanding, you want to own the assets that will go up in value as that new money floods the system.
You want to own the sponge that soaks up the water, not just stand there getting wet.
Exactly. You want your wealth in things that benefit from the system's design, rather than being eroded by it.
Man, it's a total paradigm shift. So let's just do a quick, energetic recap for everyone listening. The money in your bank account. It is not sitting in a vault. It is part of a massive, globally interconnected loop of fractional reserve banking.
Over 90% of it is purely digital.
Purely digital. Private banks are literally creating money out of thin air by issuing debt. They do it for profit. And that debt engine is what drives economic growth, but it's also what drives inflation.
It's the core mechanic of the modern world.
And the core philosophy from our source material today is this. If you understand this system, you gain power over your financial future. You can start buying assets. You can stop just hoarding cash. But if you ignore it,
you stay controlled by it. Your savings slowly lose value and you don't understand why.
Exactly. Now, before we go, I know you had a final thought you wanted to leave the listener with today, something to really chew on.
Yeah, I do. So we learned today that over 90% of money is just digital numbers.
Right.
And it's created purely as debt.
Right.
Which leaves you with a really fascinating question to think about. If almost all the wealth in our bank accounts is technically just a digital measure of someone else's promise to pay a debt, what does it actually mean to own your money?
Oh, wow. What does it mean to own your money? I love that. That is going to keep me up tonight. Thank you so much for breaking all of this down for us.
Oh, it's my pleasure. It's a wild system to uncover.
It really is. And to you, the learner, thank you for joining us on this deep dive. Tomorrow, when you check your banking app, I hope you look at those numbers through a totally new lens. You're not looking at a vault, you're looking at a living, breathing ledger. We'll see you on the next one.